Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us today. On the show, we'll be joined by Descartes Systems Group CEO Ed Ryan. Stay tuned for that interview at 11:20 a.m. Eastern Time. And now some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada added more jobs than expected last month. Data from StatsCan shows the labor force added nearly 88,000 jobs in May, well above the 10,000 economists were expecting. The agency says the gains were fueled by full-time jobs, with construction leading the way. Culture, recreation, transport, and warehousing also contributed to the gains. Meanwhile, the unemployment rate fell to 6.6%, the lowest level since January. Shares of First Quantum are down today as the future of its shuttered copper mine in Panama is to be reviewed. The country is creating a task force that will analyze multiple issues such as legal and environmental concerns before making any recommendations. The Cobre Panama mine shut down in late 2023 after Panama's Supreme Court declared First Quantum's contract invalid following months of nationwide protests. The manager of the S&P and Dow Jones indices has closed the door for tech companies like SpaceX to quickly enter the indexes after an IPO. The 12-month so-called seasoning period for newly public companies will not be shortened, nor will it waive existing profitability and public float requirements based on a company's size. SpaceX denial means that it won't be an immediate must-buy for index tracking funds. And taking a quick look at the markets right now, you can see it's an off day. Looks like the win streak may be ending. TSX off by 1.14%, being dragged down by materials. It's off almost 6% right now. Tech down as well, nearly 3%. And heading down south, taking a look at the U.S. markets. And the S&P 500 off by more than a point. The NASDAQ down by nearly 2 percentage points. And their 9-week winning streak looks like it's coming to an end this week with those numbers right there. Well, Canada has slipped into a technical recession with GDP shrinking for a second straight quarter as trade uncertainty weighs on the economy. What impact could it have on the rate decision and CUSMA negotiations? Let's unpack it with Jordan Jackson, global market strategist at JP Morgan Asset Management. Jordan, thanks very much for joining us.
Thanks for having me.
Do you look at it as a technical recession? We've heard from the CD Howe Institute, they say, well, it's a little more complicated than that. How do you treat it?
I do view this as perhaps a more material slowing down in the economy. When you look at final domestic demand, that actually contracted by 0.4% in the first quarter. So this is stripping out things like net exports, which obviously also was a drag on first quarter as well. So really focusing in on government spending, household spending, and business investment. Clearly business investment, this is now the 5th consecutive quarter that business investment has contracted. And clearly this is a direct reflection of geopolitical uncertainty as well as trade uncertainty. However, encouragingly, you do have the monthly flash GDP report rising 0.4%. So maybe we're giving some of that weakness back in the first quarter with a little bit of pop in activity. But I think this is still an economy that may have to wait till late July after we get past these negotiations to get more clarity on underlying momentum.
And if the negotiations drag on, will that kind of drag everything on as well? Or are people going to eventually have to hit a point where they're like, we need to move one way or the other?
And I think we ultimately are hitting a bit of an inflection point where we'll need to move one way or the other. The reality is both Mexico and Canada have essentially said they'd like to extend the CUSMA agreement for another 16 years. Again, that would certainly, I think, revitalize a lot of parts of the economy that have struggled under the weight of all this trade uncertainty. But we've got to wait and see. Unfortunately, the U.S. administration has been difficult to deal with, to say the very least, right? And so I think we're going to have to just wait to see how this ultimately plays out.
Is there optimism you think that this will play out fairly quickly, or do you think this might drag on? And to whose benefit is that if it does drag on the negotiations?
I think this ultimately may potentially, drag on a little bit. That being said, the U.S. does have its hand full with Iran. So it's very likely we could see the U.S. wanting to get a win in striking some sort of deal that is beneficial for both the U.S. and Canada. I would say that arguably this would be much more beneficial for Canada coming back online. The U.S. growth is expected to pop in the second quarter, and clearly the U.S. has been weathering a lot of this trade uncertainty a little bit better. But I think if a deal is struck, Canadians would certainly benefit.
All right, and with the economy, what your thoughts on the numbers today for unemployment, higher than expected, the number of jobs created? What kind of a role does that play with the economy right now?
Yeah, strong job reports on both sides of the border, with the U.S. printing over 170,000 payroll gains this month, Canada close to 88,000 payroll gains, and encouragingly that they were pretty much broad-based across the board, where the U.S. added jobs across education, healthcare, as well as leisure and hospitality. Perhaps we're seeing some hiring given World Cup and some of the games, so maybe we've got some seasonal hiring that's bolstering some of these numbers. I think what's also notable is that we saw an upward revised March and April payroll numbers as well. So now we've seen a pretty significant lift in that 3-month moving average. I hesitate to say that this is an economy that is reaccelerating. Certainly, we're not seeing a reacceleration on the wage side of things. This is an inflationary labor market, but I do think it is encouraging it certainly staves off any risk of a recession in the near term here in the U.S.
All right, and with the Bank of Canada, where does it leave the Bank of Canada now when it comes to the rates?
I think both the Bank of Canada and the Fed are on hold. The reality is, there's a lot of concern around obviously inflation. When you kind of look at the average across the Bank of Canada's preferred measures of inflation, it actually fell down to 2.1%. So we're not seeing evidence that this energy price spike is feeding through its overall core measures of inflation. So I think that provides a little bit of comfort for the Bank of Canada to not have to look to hike rates. We still very much believe that they're likely on pause for the foreseeable future. To some extent on the Fed, though, this sort of cements the Fed on hold and increases the risk that the Fed may need to hike rates. It certainly complicates Kevin Warsh's job as he steps into the Fed seat in trying to encourage rate cuts here. But I think we're likely looking at both the BOC, Bank of Canada, and the Federal Reserve on hold for the foreseeable future.
Yeah, he is. He's walking a tightrope right now with that. The Bank of Canada came out with its financial stability report. Said it's holding together for the most part. Any concerns, the positives? What did you see in it?
Yeah, I mean, it continued to highlight the business community more broadly, households as well, continue to be fairly resilient amidst a lot of this volatility. Look, I think what we're talking about here is a modest slowdown in the Canadian economy, not necessarily a crisis sort of scenario. There obviously are concerns, trade uncertainties weighing on activity. The job numbers have been very, very volatile, although, obviously last month was a welcome upside surprise. So, I think this is an environment of broadly sub-trend growth activity in Canada, although I think the skies may be clearing as we look a little bit further ahead the year, and again, after we get past the customer negotiations.
With all the stresses and challenges, is there a very good possibility that Canada could come back stronger from all this with lessons learned and things like that?
I think so. To some extent, obviously, the United States continues to be a key trading partner for Canada. But Canadians are diversifying kind of those trade routes as well. And so I think that is a net benefit in terms of its sensitivity to GDP growth and activity here in the U.S. Again, the relationship is still incredibly, incredibly important. But the more that Canada can kind of diversify those trade routes, I think the better off it will ultimately be. And I do think the Canadian economy is going to come out stronger, over the tail end of this year and into next year. And so, we do see some optimism there.
All right, we have to wrap it up there, Jordan. But thanks as always for joining us.
Thanks for having me.
Jordan Jackson, global market strategist at JP Morgan Asset Management. Coming up. To the Economist's surprise, Canada added about 90,000 jobs in May, blowing past expectations. More on that when we come back. Canada added almost 90,000 jobs in May, blowing past economists' expectations and bringing the jobless rate down to 6.6%. Still, May's job growth only partially reversing the loss of 112,000 jobs in the first 4 months of the year. Joining us now is Travis O'Rourke, president of Hayes. And Travis, thanks very much for joining us.
Always a pleasure, Roger. Good to see you.
All right, let's. I was looking at your notes. We'll get to the wild card in a second, but let's talk about the good. What are the positives in this when you break these numbers down?
Look, anytime Canada's going to add 88,000 jobs, particularly after the decline that we've been on, that's 88,000 families. It's 88,000 smiles. We have to be okay with that. It was kind of in line with what Hayes expected. I know it beat most analysts, but we see it every day. We're going to be on a couple months solid run here, Roger. This is just the first start.
So yeah, because a lot of economists were predicting, I think, about 10,000 jobs, wasn't it? And you guys were up. You were up around this number here.
I'm not an economist. I wasn't going to say it was going to be 90,000, but hiring activity, honestly, over the last 3 months, not just the volume of hiring that's happening, but the velocity of the hiring process, the frequency of counter offers that we're seeing. There's a huge uptick in employee and employer confidence that we've seen as the spring kicked off.
What's changed?
I think it's just confidence. A lot of what Carney has announced over the years, it's starting to kind of have shovels in the ground, and we're breaking some dirt in places. I think as we get closer to a July 1st Kuzma deal, that's positive. As much as we don't like to see conflict in the Middle East, when you're a natural resources, minerals, oil, gas producing country, it opens up a lot of opportunity. And we're in conversations with China, with India, with Germany. The Americans will always be our best trading partner, but we've got more avenues and more buyers of our products.
And was this also a bit, we've been going through a no hire, no fire kind of phase. Is this a bit of that ending too, that companies are now realizing they've got to move one way or the other?
Yeah, I think there's definitely a bit of a logjam that's kind of easing off a little bit. But the big one for me was to see construction jobs come through at plus 27,000. That is so important for so many reasons. We've got housing crisis. We've got major infrastructure spend that we need to do now to get to our NATO number. So the good and the bad is that construction led the way at plus 27,000. But a lot of it is kind of government injected spend. Mm-hmm. So it's not exactly sustainable, but it is still putting people to work. We did get some more residential housing kind of movement that came out in Ontario. And then I was thrilled to see British Columbia. British Columbia's had a tough go in 2026. And it was great to see that they improved as well. They've still got a lot of regulatory issues holding back their construction sector, but still positive nonetheless.
And with that construction, that you take it as a sign that things are starting to move again, right? We're starting to see movement.
We are absolutely starting to move again. Now, obviously, you got to complicate it now with new tariffs coming in. And when you look at the cost of oil, I'm not sure it's totally priced into construction projects yet, because all of that steel that you purchased to build this thing was from 6, 8, 10 months ago. And I think with the price of oil continuing to pop up and up and up, and I don't think really we see a relief in the Middle East any time now. My concern, fingers crossed, is that construction will continue to move forward, but the costs are going up and up and up, and it's going to be passed on to consumers. As we saw in the retail jobs going down, consumers are starting to tighten up now. We've got an insane debt to household income ratio going on. And when, 58, give or take, percentage of nominal GDP comes from consumer spending, there are worrying signs ahead. That's not all good news, mm-hmm. but I do think there will be a lot of hiring over the next couple months.
That debt to income, 175%, how does that compare historically?
It's not at the highest, Roger, but it's near the highest. And it's getting worse period over period. And when we see wage inflation tick from 4.5 down to 3, it's not going to come from people earning. So I think we need to watch it. It's 1 month of retail jobs going down, but to see a great movement in youth unemployment next to retail jobs where usually youth work, what we can see there is that a lot of those youth jobs have just come from government work, which is not really sustainable. Mm-hmm. Canada Youth Jobs or Canada Summer Jobs was meaning to hire 100,000 kids. Not a lot of it are coming from the private sector. So those are not long-term sustainable jobs. Nonetheless, they're at work. But if you kind of take a step back and you think, well, construction's gone up because government are spending on infrastructure. Youth jobs are going up because government is spending on youth jobs. We really need the private sector to catch up here. Yeah. Our elected officials are doing their part, and hopefully the private sector will start to do theirs.
All right, let's get to the wild card, and then I want to talk about AI as well. Manufacturing, what's the concerns or what's the wild card about that?
Yeah, like manufacturing was good. Look, we're up 15,000 or so jobs, which was awesome. But once again, we got a June 2nd new tariff coming in against Canada, UK, EU. We've got this looming Kuzma hanging over our head that's going to come up in like 4 weeks or so. And we've got an insane increase in the price of oil and gas. And like, look, that's in everything. It's going to be in every manufacturing facility. It's in almost every part. It's in every plastic. It's in the steel. And the cost to manufacture goods is going to keep going up. Our trading partner keeps treating us a little bit worse and worse with the costs. I think that spells a bad end for us.
All right, and before we go, I want to get to AI. It's starting to have, we're starting to feel the effects of it, aren't we?
100%. 100% AI is impacting jobs. And I would say it's in particular at that recent graduate level. And companies, they're just not hiring entry-level grads as much as they used to be. You can almost go across any functional area of a company, and AI is now capable of doing a lot of those entry-level tasks. And I think the youth unemployment, again, propped up by some government jobs, but someone who's in the sector right now, I'm telling you, organizations of all sizes, from mom and pop to big 100,000 employers, they are holding off, and they've spent a lot of money on AI tools, and they're trying to get their return on investment. And right now, entry-level jobs are absolutely the ones paying the price.
All right, we have to wrap it up there, Travis, but always appreciate your insight. Thanks for joining us.
You got it, Roger. Take care.
Cheers. Travis O'Rourke, president of Hayes. Up next, we'll hear from the CEO of Descartes Systems on what's behind their Q1 performance and how ongoing disruptions in global shipping could impact their outlook. That's ahead. Descartes Systems reported a strong first quarter driven by higher demand for its supply chain, customs, and trade intelligence software, but the company is still navigating weaker freight volumes and ongoing disruptions across global trade routes. For more on this, we're joined now by the CEO, Edward Ryan. Ed, thank you very much for joining us today.
Hey, thanks for having me.
A good quarter for you with some challenging, a challenging macroeconomics going on there. How did you manage to pull that off?
And we had a lot of, freight markets were down about 4%. We were up about 9.5% organically. So we're real happy about that. We had a lot of products that were, really performing well. And, customers were buying more stuff from us. We did a pretty good job of taking business away from some of our competitors. And it all added up to a big quarter. AI has been starting to, kick in for us as a revenue stream now. And so probably picked up a couple points from that as well. So, it was a good quarter for us, especially considering the freight markets were down a little bit.
With the organic growth at 9%, do you feel that's sustainable, or is it going to come back down a little bit?
Well, we'll have to see what happens to our customer base. I think we're going to continue to do well. We're going to continue to be able to sell our software solutions. There's a lot of complexity in the world with some of the wars going on and trade conflicts. That usually helps us quite a bit. If the freight markets turn up, I think we could do even better. We like where we are right now. I think we can continue this kind of growth for a little while, at least.
And you mentioned about taking away from competitors. Was that with lower prices, or was that, or did you maintain prices and just the quality?
No, quality service. A couple of the businesses we operate, we just do a better job than anyone else in the market. And I think over time, people have decided to switch to us, and we had some. In the Type 86 filings, which is, de minimis filings that you might have seen the U.S. Eliminated. They switched the filing type. We ended up picking up a bunch of business there from competitors that, didn't really run a network and couldn't process the transactions as fast as they needed to kind of get the business. We picked up a bunch from that. Our MacroPoint business is really doing well and picking up a lot of business with freight brokers and stealing it away from some of our competitors over time. So, probably 4 or 5 businesses of ours are really just doing a better job than our competitors, and as a result, picking up, market share.
And now there were some challenges. You had your overall gross margin compression declined, operating expenses grew. What was behind those?
As our business grows and as we buy more companies, you're going to see our operating expenses grow. They will naturally with that. I don't care really. We're growing our EBITDA margin 15% a year, and in fact, this past year we just did 20%. So we tell people we'll do 10 to 15% or better, and oftentimes we do better. This last year we did 20%. So you're going to see our costs go up when that happens, right? Because we have a lot more revenue coming in, and we're turning it into more profits. That's exactly what you want to do. But as the business grows, we're going to have our costs grow as well. We think we're pretty frugal and manage our costs pretty well, and that's why you see us putting up 46% EBITDA margin, which is a very healthy number. But as we grow, we're going to have to grow our expenses. Of course, we need to keep building more product, and we buy more companies, and that has additional costs. And so that's just the way it is.
And with that, you've got a pretty good war chest going on right now. What acquisitions do you see coming down the pipe, or possibilities? And is it better in the circumstances we're in right now, or is it more challenging when you're trying to do some M&A?
It's actually it's gotten a lot better. You see what happened in the public markets, the software stocks. I don't know that we feel that was fair, but it is what it is, and that's now hitting the private markets. And as it does, you're seeing the game that was going on for the last 10 or 15 years with private equity firms getting largely free money from the government and banks. And, we always made our profits and we used that to buy companies. And, that's becoming, a great way to have done it because, as we make more money and we keep making more money every day, we're in line for these acquisitions and we have the money to do it. And when, some of the sources of funding that private equity firms had start to dry up, they're not competing against us anymore. And we're, competing for these deals either to buy stuff from private equity or from sole proprietors. And, we have the money to do it because we're making a ton of money every quarter operating our business. As the markets settle out here a little bit with private companies, we find ourselves in a situation where we're one of the few guys at the table and there's a lot of stuff for sale. So that's been great for us. And I suspect it will for some time to come. Similar to what happened in, 08, 09, 10, 11, as coming out of the recession, we were one of the few guys that were still making money and able to buy companies and most of the other people were not at the table.
And you mentioned in the call, but you don't see yourself as a software company.
We're a network. I mean, we process transactions for a living. We have a very unique data set as a result. That data set is very well positioned to take advantage of AI. You can already see that in some of our numbers as we're rolling out new AI functionality very quickly. The beauty of it is we're able to build it fast because of the way the tools work, and we're able to leverage the data that we have on our global logistics network into tools that can really help our customers operate more efficiently. Of course, that's all written in software, but it's, I don't sell the software very often as just like a per seat, kind of software package. It's people use our network to communicate with their trading partners and execute logistics moves and manage their supply chain. And that makes us a little different from a lot of the software companies that have been getting hit hard in this, last 6-8 months. And at the same time, we're in a technology fund. If someone wants to sell out of that technology fund, they're going to sell our stock as well at the same time. As I think that's going to end at some point and people look at us, they're going to go, hey, these guys are different than the rest of the software companies out there, and they're better positioned to take advantage of AI. And I think that's going to be an attractive time for us.
All right, Ed, we have to wrap it up there, but thanks as always for joining us.
Thank you. Ed
Ryan is the CEO of Descartes Systems. When we come back, Scotiabank's latest report looks at how Canada and the U.S. are on different tracks. We'll find out why with one of its authors. Stay with us. Canada added more jobs than expected last month. Data from StatsCan shows the labor force added nearly 88,000 jobs in May, well above the 10,000 most economists were expecting. The agency says the gains were fueled by full-time jobs, with construction leading the way. Agriculture, recreation, transport, and warehousing also contributed. Meanwhile, the unemployment rate fell to 6.6%, the lowest level since January. Shares of First Quantum Minerals are seeing some pressure today. Panama is creating a task force to study the miner's shuttered copper mine. The interagency team will evaluate the future of the mine and will analyze a range of issues, including legal, economical, and environmental challenges before making any recommendations. The task force is the latest move toward a decision on whether the mine can reopen. Shares of Lululemon are trading sharply lower after the maker of yoga wear cut its profit and sales forecast for the full year. Lululemon says its performance is being affected by negative commentary in the media and online about its brand. It also says not all product launches have met expectations, and the now resolved proxy contest with founder Chip Wilson did not help. Quick look at the markets, and you can see a sharp sell-off today after a nice run through April and May. It's the TSX off by 1.5% right now. South of the border, not much better, probably even a little worse. Yeah, look at the NASDAQ now, 2.22% it's down by, and the S&P 500's pulled back 1.22% to end their weekly run of wins. One of Scotiabank's latest reports notes that Canada and the U.S. are on two different tracks, with the Bank of Canada moving to normalization, while the Fed is prioritizing labor market weakness. Here to discuss that and more is Olivier Gervais, Modeling and Forecasting Director at Scotiabank. Olivier, thank you very much for joining us.
Thanks for having me.
All right. Bank of Canada moving to normalization. What does that mean to them? What does that look like to you?
Yeah, so in Canada, what we see is that currently the policy rate is lower than what we call the neutral rate. So it's kind of stimulative right now. And as the economy gets into better balance, well, we expect the Bank of Canada to remove some of that stimulus later this year and in 2027. We also see this as risk management to some extent. So we view risk to inflation on the upside, especially with everything that's going on with Iran, oil prices. But also when you look at like input costs, all of those things are quite hot in Canada and are suggesting some upside risk to inflation. So we think that to some extent, the Bank of Canada will try to lean against those risks and remove some of the monetary stimulus towards the end of the year.
It is a challenging situation. There's a lot of everything going on right now, isn't there?
Oh, yeah, absolutely. You saw Q4 very weak in terms of economic activity, followed by another weak Q1, weak labor market. But all of this is interpreted as being temporary. Actually, you saw today the labor market release from StatsCan is actually quite positive. So it looks like this is supporting our narrative. But, there's a lot of uncertainty with, where the economy currently stands, where it's going, and all these risks coming, geopolitical risk, but also everything that's going on with trade and CUSMA, and so a lot of complex stuff for sure.
And what would change the way you're looking at this right now? What would be a key thing that might change it?
Yeah, so I think one of the things that we're really looking at is everything that's going on with oil prices, how fast. The market is expecting oil prices to go down. This is what we have built in our forecast, but it is a very, very important variable. We actually published a note, I think earlier this week, on a scenario where oil prices stays elevated for a long time, and that would feed through inflation expectations. That would be quite major, actually, if that scenario were to play out. So that's one thing that we're looking at. Of course, everything that's going on with CUSMA, that's on the other side. So if the negotiation takes longer, if it fails, this could also derail quite a bit the Canadian economy.
And with oil and with inflation, is it hitting the U.S. different than Canada, or are they feeling it pretty much in the same way we are?
I think they're feeling it in the same way. The thing is, in the U.S., it's a bit different. The economy is in excess demand, which means that it's growing faster than what it can usually in the long run. And also, they have tariffs, but they're seeing the same type of input cost, in the U.S. But the thing is, with the economy in excess demand, I think firms have a better are better able to actually pass this through consumers, pass this to consumers, sorry, and lift inflation. Actually, you see inflation quite elevated right now, and it's quite concerning for sure.
And then, and with the Fed, you're saying they're prioritizing labor market weakness. The numbers just came out today. There was an improvement down in the States, not a huge, but somewhat a little bit of an improvement. But although the rate stayed the same, the rate stayed the same, though.
Yeah, for sure. I mean, the 1 month of data is not going to derail our forecast. I think you have to have a lot more. Have to have an accumulation of evidence. But yeah, it's a good release in the U.S. That said, it looked like it was quite targeted. Not as broad based as the release in Canada. But if you look at the trend, like recent releases in the U.S. over the last year, it's not very, very strong. So yeah, we expect especially household spending to continue to slow in the U.S. and that will drag growth for sure, at least in 2026.
And where does that leave the Fed?
Yeah, so the Fed, we think, is going to focus a lot more on this weak labor market, trying to support job growth, trying to support GDP growth. This will have some impact on inflation for sure, but I think it's a question of choice. They will want to put more emphasis on growth. Remember that the U.S. has a dual mandate. They want to control prices, but at the same time, they also want to support the labor market.
And then there's the pressure from the White House as well for cuts. But is that
possibly
is that a possibility?
It's possible, but I mean, this is anybody's guess. But I think we've seen from signals from the institution that they would try to support that and look through most of the inflation increase.
All right, and then just one last, just about we talked about the numbers on the States. Numbers up here were better than expected. What does that mean? Or you said it's only 1 month, I know, but positive is better than not positive.
Absolutely, no. It's actually very positive. I think it's positive. We were expecting to some extent an improvement in the labor market. It's happening a bit faster, I think, than we were expecting. But when I look at the data this morning, it's broad based across provinces. It's hard to see a negative out of that. I think it supports this narrative that the economy was going through a soft patch, temporary soft growth in early 2026, and that the economy is rebounding. And I think this number simply supports this narrative.
Okay, we have to wrap it up there, Olivier. But thank you very much for joining us.
Thanks for having me.
Olivier Gervais, Modeling and Forecasting Director at Scotiabank. Coming up, we'll bring you our conversation with Pierre Poilievre, leader of the official opposition. Stay with us. The Liberal government shared its long-awaited AI strategy yesterday. It's called AI for All. To get his perspective, we sat down with Pierre Poilievre, leader of the official opposition.
Well, first of all, we do need to have privacy protections. We need to make sure that people can control and be aware of how their information is used. Second, we don't believe in creating a gigantic corporate welfare fund that will subsidize liberal insiders and others who have lobbyists, consultants, lawyers, and other insiders in order to get taxpayers' money for AI. If businesses want to adopt AI, great, good for them. Invest your own money and get a return on it, but don't force workers through their taxes to pay corporate welfare to companies that are phasing out their jobs and replacing them with AI. We're worried about this being yet another example of Carney governing for the consulting class, the little club of liberal insiders who will be filling out application forms to get grants for the latest AI buzzword. And I think the risk here is that AI becomes the new green energy, which was the trick that liberals like Carney used to get countless tax dollars extracted from the working class to benefit narrow corporate politically connected interests.
Okay.
And we don't want to see that again. So we'll be scrutinizing how this money is spent and ensuring that the liberals don't get to use it just to enrich themselves and their friends again.
Okay, we're talking about a $2.3 billion investment into a bunch of different lines for the Canadian people and for Canadian companies. But the question was about protecting Canadian sovereignty, Canadian data. Australia, for example, has banned children under the age of 16 from engaging with AI chatbots. Would the Conservatives do that if you led the country? Would you do the same?
Well, first of all, we have to figure out how it is that the government would enforce it. We're not in favor of creating a mandatory digital identification, which would be massively intrusive. So we want to know what methods the government would propose to identify someone's age before we would even consider something like that. In terms of data sovereignty, which was also part of your question, we need to ensure that our data is not stored on servers in foreign hostile countries and under the control of foreign hostile regimes like Beijing. The way you get the data here is to have to remove the anti-development laws so that we can generate the power necessary for the compute that would provide and use that data. And that is one of the reasons why we want to get rid of Bill C-69, the anti-development law, the industrial carbon tax, so that we can generate more affordable natural gas-powered electricity. That's how you ensure that the immense energy that's going to be required for this sector is available, abundant, and job creating.
Okay, so you would want more development in Canada. Would you then say that we need to reduce our reliance on American big tech companies to keep our data and to keep our sovereignty?
Well, the truth is the Americans are going to have a hell of a time producing enough energy themselves to power these data centers. I mean, one ChatGPT inquiry that you put into your computer takes about 9 times as much electricity as a Google search does. The Americans are already at capacity in terms of the electricity they consume today. I think they're probably going to be turning towards us to have us provide more of this energy. So I think it's actually something we can bring to the table in the forthcoming CUSMA negotiations. We can say, look, we're going to get rid of C-69, the liberal anti-development law. We're going to get rid of the industrial carbon tax. We're going to provide rapid permits for the power stations that will supply the energy. And then you can store your data in Canada. And that would give us a lot of strategic weight and power, and would create a lot of jobs and revenue for our people. So that is one of the things that we think provides potential and opportunity for Canadians.
Okay, so you would be okay with a company that is actually American, but would have a location in Canada for the data storage of Canadians?
Well, they'd have to hire Canadians. They'd have to pay Canadian taxes. They'd have to buy Canadian energy, which would support the Canadian energy sector. And of course, they'd have to respect our rules and our laws. This is Canada. We set our own rules here. But if we can make those attractive to investors around the world, and why not create tens of thousands of jobs for our electricians, industrial carpenters, millwrights, and engineers in the process?
The Liberals say their AI strategy will lead to $200 billion in economic growth, create 250,000 jobs over 5 years. Do you see AI as more of a risk to Canadian jobs or a creator of jobs?
First of all, I think we all have to stop reporting on these phony numbers that Mark Carney publishes. He constantly creates random round numbers and has no backup to support that they will ever materialize. He's got no plan to do any of that. He actually wants to increase the industrial carbon tax 6-fold, which would make it impossible to supply the natural gas-powered electricity that would go into these centers. He's kept the anti-development laws of Justin Trudeau, C-69, and others. And so the likelihood of any of that materializing is extremely low. But our view is that there should be a free market, and that as long as businesses follow the rules and the privacy and the safety of our people are protected, then the job creation that results from building data centers and having more high-tech employment in this country will follow.
Okay. You also mentioned at the start of our conversation that you don't necessarily support giving money to companies, smaller companies, mid-sized companies, to adopt an AI strategy. Why is that?
Well, let's be. I didn't say that. You said that.
What you were saying was that for the adoption for AI, you don't support handouts to companies to do that. Why is that?
Right. Well, you were the one that said smaller and mid-sized companies. I did not say that.
Those are the companies that are going to need some help in adopting that. So would you be against giving smaller or mid-sized companies a help or a hand to adopt some of the AI strategies?
To be clear, small and mid-sized companies won't get the money. All of the research and scholarship on corporate welfare programs show that they end up going to big multinational corporations that have lobbyists. And that's exactly what will happen here again. In fact, Liberals said that they want the money to go to quote-unquote national champions, which is code for multinational large corporations with a swarm of lobbyists on Parliament Hill. Whenever government decides who gets what, it's the politically powerful that get all the money. Small businesses will again get crushed. We're in an entrepreneurial drought after a year of Mark Carney. We've had month after month of more businesses closing than opening. And so expanding corporate welfare has not helped small businesses. They get the cost, they get the bills. The well-connected companies like Brookfield end up getting all the grants and contributions. So I want to get rid of the corporate welfare and lower taxes. How about this? Why don't we get rid of capital gains tax on businesses that reinvest in Canada? That way we will allow businesses and individuals, by the way, to invest their own money, and they get rewarded if that capital is deployed creating Canadian jobs, inventing Canadian technology, building Canadian pipelines. That is a patriotic, free market way to get a return that will be much superior to what was proposed today.
That was Pierre Poilievre, leader of the official opposition. Coming up, we'll get the latest market update on Bay and Wall Street. That's after the break. Canada is officially now in high-level talks with the U.S. on the future of trade between our two countries, but federal officials aren't the only negotiators making their way to Washington. Several provinces have their own trade offices in the U.S. Capitol. CTV's Abigail Beeman now on what, if any, impact the provinces are having.
When half a dozen Manitobans met with U.S. officials to talk trade this week, it was a first in history.
Manitoba produces about 8.5 million pigs every year. 3 million of those are exported live into the United States. Those exports are at risk if we don't have the protection of the trade agreement.
They signal that even though the president signed the agreement 6 years ago, he's not attached to it. So there are some irritants that need to be worked out.
Manitoba is the newest province with an office at the Canadian Embassy. Ontario and Alberta have had theirs for 1 and 2+ decades. But in this trade war, the 4 provinces in D.C. meet bi-weekly around this table. Ontario's representative says it's been effective.
We hope that helps our federal government on things like doing trade agreements, because so many of the things that are in the American interest really rely with the domain of the provinces.
One of the things I do is like to show them oil sands.
The reps spend a lot of time scene setting to Americans. Alberta's brings this sample to meetings. Nathan Cooper says the issue of Alberta separatism hasn't played a significant role in talks.
On occasion, I'll hear from members of Congress, more so out of an interest of like what's actually happening there. But it very quickly moves on to the key issues that we all face together, which is largely energy and agriculture.
President Trump's back on his high horse, saying we're going to be a 51st state. I can tell President Trump that will never, ever happen.
Asked if some of Doug Ford's comments make his job harder on Capitol Hill, David Patterson says he's met with 150 Republican lawmakers and has not had a bad meeting yet. He's optimistic about a CUSMA deal, but not by July 1st.
If the United States is willing to do it, I hope they are, because I think it's in their self-interest. And so let's get it done by Labor Day.
Ontario's premier visits Washington next week. Alberta is focused on hosting U.S. lawmakers at the Calgary Stampede and beyond. Quebec didn't get back to us. Abigail Beeman, CTV News, Washington.
All right, let's take a look at the markets, see how Bay Street and Wall Street are ending the week. I don't think you're going to like what you're seeing right now. Everybody is off today after hitting record highs most of the week. It's been a pullback, quite the pullback today. The TSX is off by 1.8%, back down 34,500 almost, 34,600. And S&P 500 off by 1.4%, down below 7,500, and the NASDAQ is pushing back towards 26,000. It's off by 2.3%. A couple of stocks of note we want to show you about. Curaleaf did their 1-for-3 reverse stock split. It became effective today, and you can see it's up on that news. Of course, cutting the stocks by third out there, so that is helping it right now. And the other one we want to talk about, TerraVest, is taking a huge hit right now. It is off 26%, and at one point trading was halted. It's been resumed, and part of the concern with it looks like they had a deal. They announced a deal. A Jet Penture was announced yesterday, and it was funded by cash on hand and using existing credit facilities. But the market reaction, investors not too happy about the capital allocation for this, so that might be the concern for them right now. And right now, just looking at some of the analysts on this one, there's 5 buy, 1 hold, no sell recommendations when it comes to TerraVest. And market calls coming up next. Today on the show, we have Brian Madden. He's the Chief Investment Officer at First Avenue Investment Council. He'll be taking your questions on North American equities. Thanks for watching Morning Markets. We'll see you tomorrow.